Today we're going to be looking at INV2601. I'm going to be looking at another past paper. This past paper is October-November 2016. Remember, exam technique is very important. There are 40 multiple choice questions and you need to get 20 of them correct in order to guarantee a pass. So I would definitely suggest that you find 20 questions that you can do that's relatively easy to do, that you feel most comfortable with, and complete those first, and then come back to more difficult or longer questions, such as the put-call parity equation, or maybe the bond calculations where you're looking at calculating duration or convexity. Those questions take a bit longer to do. So I would do the easier questions first. Theory is easy normally, and time value of money questions as well. So I would definitely start with those. Remember, try get your 20 questions right first, guarantee the pass, and then focus on getting the distinction. It's a 2-hour paper, so make sure you watch your time carefully. You do need to try complete 20 questions in the first hour, and then leave the last hour for the last 20 questions. That's just some exam technique to share with you before I start with this past paper. So let's begin. The first question we have here: an analyst at Malaku Bank will transact on the that's rand dollar foreign exchange market. The analyst is, however, concerned about the future market fluctuations and gathers the following information on the rand dollar rate is currently trading at 14.93 to a dollar. The expected rate of inflation is 6%, and the real risk-free rate of return is 12%. They want the nominal rates. Obviously, when I see nominal, when I see inflation, and when I see real, I know this is looking at Fisher's equation, looking at the relationship between nominal inflation, nominal real and inflation. So your nominal rate provides for the real rate and inflation. So we need to write down the equation and then do the mathematical substitution. So 1 plus nominal equals 1 plus real times 1 plus inflation. We're obviously calculating the nominal risk-free rate, and we've got inflation at 6% and risk-free at 12%. Inflation at 6 and 12. Alright, that's literally what you're doing, and then you'll obviously take the negative 1 across. So I'm going to have n equal to 1.12 times 1.06 minus 1 gives me 18.72%. Option number 3. Question 2. The holding period return on investment that Moser made in 2014 that was held for a period of 11 years is 7.82%. If the ending value of this investment was 42,800, what is the beginning value? That's a time value of money calculation. The textbook does give you a manual equation to work out. Remember, it's a multiple choice exam, so you can use the equation, which will take you longer, or you can just practice using your financial calculator to get the right answer. So I'm going to use the financial calculator because it's simpler, it's quicker, it's easier, it's faster, and it's more accurate. How many years? 11 years at a rate of 7.82. Future value is 42,800. Solve for present value. Right, so I grab my financial calculator, I insert n as 11, I insert I as 7.82, and a future value of 42,800. And I'm solving for the present value, and I get 18,696.10621. 18,696.11, perfect, option 2. Question three is theory. Which of the following are characteristic of well-functioning markets? Okay. External efficiency, definitely. Low transaction costs, yes. Unavailability of information, no. Liquidity and price continuity, yes. A, B, and D. Option 2. Not 3. Why did I write 3? Option 2, right? A, B, D. A, B, D. That one's out. Correct. A, B, D. 2. 3, 2. Okay, question 3, number 2. Right, question 4. If you place a stop loss order to sell 500 shares of N at 125 when the current price is 130, how much will you receive for each share if the price decreases to 120? Okay, well, if you place a stop loss order to sell, okay, so you're selling at 125, current price is 130, and you've got a stop loss here, stop loss of 125. How much will you receive for each share if the price decreases to 120? So if the price drops to 120, well, the trade will close at your stop loss. Okay, a stop loss is there to protect you, to mitigate the loss in the event of something like this happening. Okay, so you've got a stop loss order to sell 500 shares at 125. Current market price is 130. So if the market price falls below 125, you'd obviously get stopped out at 125. So the trade will close at 125. Okay, close to 125. The reason why they say close to is because, remember, the market prices change very quickly, so it might be difficult to fill your stop loss order at exactly 125, but it should be close to 125. That's the stop loss. The stop loss is there to protect you when the trade goes bad. Question 5. What is the most important determinant of investment returns? Well, if I'm looking at the determinant, what determines your investment returns is what you choose to invest in. So obviously asset allocation. Correlation, that would be a factor, a measure. Liquidity, a measure. External efficiency, that's looking at efficient markets. Option 3. If a company has a beta of that, market rate of that, risk-free of that, the company is expected to pay a dividend of that with no further growth anticipated. Determine the value of the firm's ordinary share. Okay, when I see beta, market return, and risk-free, I know that's CAPM. So make sure you do the CAPM calculation for required return. Required return is risk-free plus beta, brackets, the market return minus the risk-free. Risk-free in this question was 7. Beta was 1.3. So 7 plus beta 1.3, multiply that by the market rate of 11% minus 7. 11 minus 7, close brackets, equals. So we're looking at a ratio of how much? Let's see what we get. 12.2%. The company is expected to pay a dividend, and there's no further growth anticipated. So we're obviously got Gordon growth model without the growth. So PV equals the div1 over R minus G. Obviously there is no G, it's 0. So div1 is the expected dividend of 4.30 divided by R, 0.122, close brackets, equals, minus, obviously minus 0, which you don't have to show, and that gives me an answer of 35 Rand 24, 35 Rand 24.5. So if you round off, 35.25, 35.25, 35.25, yes, option 2. Question 7. You are the financial planner of Z. Your client wants to invest in Z. We've got possible outcomes. Okay, so we've got pessimistic, most likely, and optimistic. In terms of probability, we've got 50%, 30%, 20, and we've got the rate of return. They want the expected rate of return. So if I'm looking at the expected rate of return, I'm going to have to use the expected rate equation, the table method, okay, in order to calculate my expected value. That's basically what I'm looking at doing here. So my expected value will obviously be probability times rate of return, and then sum that up. So I'll just need two columns here: probability return. My probability 50, 30, 20. And my returns 18, 14, minus 3. Expected value calculation. This times that for all of them, and then sum up. 12.6%, option 3. Question 8. Determine the expected returns of share A when using the arbitrage pricing theory. Okay, remember, arbitrage pricing theory, according to the investment theory, relates to your CAPM. It's another method to estimate risk versus return in order to get a valuation around what the rate should be when discounting future cash flows back in time. So if I'm focusing on the arbitrage pricing theory, I need to start with something which is there, the zero, which is like a risk-free. It's almost like CAPM. And then you've got these different measures in terms of beta as well as the return. So when looking at the arbitrage pricing theory, it's just it's almost like a how can I say? It's almost like a derivative of the CAPM equation. Okay, where they've expanded, they've just used different investment theory to calculate an expected return. So the expected return of A would be 6.2. which is the starting point. So the expected return would be 6.2 plus, open brackets, the return here. I think, let me shrink this and then you can see everything. That might be easier, and then you can follow with me as we go. Okay, and that's where we are currently. So what was my wrong question? That's the one. There we go. Let's just rub out all this other lines. Okay. Right, so if I'm working out the return, I've got the 6.2 and I'm adding the 5.4 times by the 0.65, close brackets, plus, open brackets, the 8.1 times the 3.8, close brackets, equals. That was 3.8, which was beta. Let's add all of that up. $40.49, which we can see is option 3. Question 9. Question 9 looks like theory. Okay, so which one of the following is most correct? Most correct meaning true. Investment theory is used to identify total risk and measure the return. No, it doesn't. It's looking at more than just that. The semi-strong form assumes that security prices adjust rapidly to all perfect markets. No, that wouldn't be semi-strong. The changes in slope of the security market line is caused by changes in the standard deviation. No, it isn't. And the capital asset price model links together undiversifiable risk, which is market risk, which is systematic, and all returns for asset. That's correct. 4. Question 10. S will start receiving equal beginning of year deposits. That's important. Begin mode on your calculator of 563 years from now for a period of 5 years at a rate of 13%. Determine how much is this investment worth today. Okay, so we need a timeline. T0 T1, T2, T3, T4, T5, T6, T7, T8, T9, T10, and so on. Okay, so they said S will start receiving equal beginning of year deposits. So beginning of year deposits 3 years from now. So 1, 2, 3 years from now, at that point in time she'll receive 560 for a period of 5 years. 1, 2, 3, 4, 5 at a rate of 13%. Determine how much is investment worth today. Okay, so in other words, what do they want you to do? Work out the present value here. Right, so you've got a future annuity that you need to discount back in time. Right, so I need to work out what the present value is here and then take it back to T0. So first things first is to get the annuity. So I'm going to use a normal annuity and I'm going to work out the PV here for this annuity at time 2. Either way you're going to get the same answer. So I'm obviously going to work out the payment, which is 560. The rate is 13%. The N is 5 years, so 5 payments, so 5, and then solve for PV. Right, then I'm going to take that PV, that's going to become my FV, FV PV from before. Okay, and then N is going to be 2, because I'm going to discount it 2 years back to time 0, and I'm going to use I13 there. Okay, so if I do it this way, I don't need to then change my mode on my calculator because I'm using this as a normal annuity, not beginning of the year. Okay, beginning of the year means starting at 560. So you could use begin mode, but then if you work out the present value, you're going to get the present value at T3 if you use begin mode. I'm using N mode. So if I use N mode, then I'm going to get the PV at time 2, which is a normal annuity. Okay, you can do it both ways, you'll see you'll get the same answer. And then solve for PV. Okay, so first things first, get the PV. Get this bit. Alright, so on the calculator, N is 5, I is 13, payment 560, solve for the present value. Present value comes out to 1969.649506. Take that figure, insert that as your future value. Then work out your present value based on those variables. So N2, I13, future value is the answer that we just worked out. Present value comes out to 524478. 52, that's option 1. Option 1 is there, that's the answer. Great, let's look at another question. Question 11. Question 11 says, what is the growth rate of the funding stream of cash flows? Okay, so growth rate, that's your PV, that's your FV. How many years? 1, 2, 3, 4 years. Solve for the I. Let's put that in. 4 PV equals negative FE equals 2840. Solve for I percentage equals. Right, so on your financial calculator, in here 4 years, PV negative 2500, future value 2840. Solve for the I comes out to 3.2391886662. Okay, so that's 3.329, which you round off is 3.24, which is option 1. Question 12. M has issued 7.5% pref shares at 150. What is the intrinsic value per share assuming required rate of 8%? Okay, so obviously this is a perpetuity, it's preference share, so PV equals the div 1 over R, no G. So they told you this was 7.5% pref shares at 150. So your dividend is going to be 150 times 7.5%, and then you're going to divide that by a required rate of 8%, equals 140,625, which you round off is 140,63, option 3. Question 13. Al makes an investment today from which he will receive that 10 years from now. So that's future value. This investment entails a risk premium of 9.2%. Investment in treasury bills. When I see treasury bills, I know that's the risk-free rate. And interest is payable monthly. That's important. How much should he invest today? Okay, so we know what the treasury bills are, which is 14%, so that's a CAPM equation, but they gave you the risk premium of 9.2. Alright, so your required return is just going to be 14% plus the risk premium of 9.2%, which is 14 plus 9.2, 23.2 is your required return. That's your R, or that's your I. This is the I in the calculator. Okay, what else do I need in the calculator? Future value, which was given. They said you're going to receive 632200 10 years from now, and that's payable monthly. So if it's payable monthly, it would be compounded monthly. So then you would have N equals 10 years from now. So 10 times 12, 120 months. Then the I here needs to be divided by 12 to get the I12. I12 is the monthly rate. So if I take this, divide that by 12, I'm going to get that, and I'm going to solve for PV. Okay, so you grab your financial calculator. N, 10 times 120. Not 10 times 120. 10 times 12 is 120. I is 23.2 divided by 12, which is at 1.93 recurring. Future value comes out, future value is 632200, and solving for present value. Present value comes out to 63519.53772. That's option 1. Question 14. K Limited has a payout ratio of 74% and a return on equity. When I see payout and return on equity, I can calculate growth because I need retention times ROE. That's what I'm thinking about. It also has a required rate of return of 15% and a current dividend of that. What is the intrinsic value of the share using the constant growth model? See, constant growth model is Gordon growth. So just to show you that equation for the return on equity calculation, our notes, there we go. Okay, so I need this. Okay, growth is retention times ROE. That's a formula that you would have learned from your theory in your textbook. And obviously Gordon growth model is that. Okay, so that's what I'm going to be using to calculate the answer here. Okay, so go back to the question. K has a payout ratio of 74%. I want growth, so G equals brackets. Retention is 1 minus payout. So 1 minus 0.74 gives me the retention. Okay, so whatever I don't pay out, I retain. So if I'm paying out 74%, I'm going to retain the leftover, what's left, so 26%. Okay, which is 1 minus 0.74. Right, multiply that by return on equity, which is 37%. That gives me a growth rate of 9.62%. Okay, it also has a required return of 15%. Then I plug it into Gordon growth. Okay, but I want div 1. They said current dividend. So see, they even gave you a div 0 here. So obviously you're going to have to compound that for one period worth of growth. So 1,0962, which is your growth. Okay, then divide that by open brackets 0.15, which is your 15%, less your growth rate. Close brackets equals. Type that into your calculator and you get an answer of 46.86, 46.86, 46.86, option 4. Question 15. The following information relates to B. Okay, so most recent dividend per share, most recent earnings per share, net profit margin, total asset turnover, financial leverage. What is the return on equity? Okay, return on equity is DuPont. So DuPont is very popular in finance and investment, so make sure you learn the equation for DuPont. Net profit margin times total asset turnover times financial leverage multiplier. Did they give you net profit margin? Yes, they did, 28.4%. Did they give you total asset turnover? Yes, they did, 0.65. Did they give you financial leverage? Yes, they did, 2.21. 2.10. Type that into your calculator, and you get an answer of 38.76. 38.76, 38.77, which is option 4. Question 16. M share price is currently trading at 40 Rand. It expects next year's dividend per share to be 2.30 Rand with a constant growth of 6. Given M's risk, you have a required rate of 12%. What is your expected rate of return on the investment decision? Okay, so you're working backwards here. You're doing golden growth, but you're working out the rates. Okay, so that's what I've got in the question. In terms of my variables, the PV currently trading at 40 Rand. So 40 Rand equals div 1, which is 2.30 Rand, divide by open brackets the rate, which is growth is 0.06, which is growth. So the rate is what I'm searching for, minus 0.06, close brackets. Okay, that's what I've got here. What is your expected rate of return investment decision? Okay, so I'm going to work out R. I'm going to take this across, so it's going to become multiply, and then I'll have equals 2.30 there. Okay, so if I take the divide to the left, it becomes multiply, so I'll have 40R minus, let's see, 40 times 0.06 is 2.4 equals 2.3. Okay, then I take the 2.4 across, so 40R equals 2.4 plus 2.3, which is 4.7. Right, and then R equals 4.7 divided by 40, which is 4.7 divided by 40, which is 11.75%. That would be the rates of return. Okay, you know that the required rate is 12%. Okay, so you've got a rate of return here of 11.75. 11.75% is what the required rate is, what the rate is, the return is. That's the expected rate. So you're expecting 11.75. Your required is 12%. So you actually require more. So you wouldn't buy this, you would sell it. Okay, because the required return is 12%, meaning this asset isn't offering sufficient return on investment. Okay, so you're not going to go with this particular asset because it's only going to give you 11.75 when you want, in terms of required, 12%. So you would sell this if you're holding it as part of your portfolio. Okay, so question 16, option 2, because of what I just discussed there. Okay, 17. D, just paid dividends. So just paid means that's times 0. See, you need to pick up on keywords like that in the question. Just paid means times 0, which is 2.12 per share. Okay, that's the dividend. Assume that over the next 3 years, dividends will grow as follows. Okay, after that, expected to level of constant growth. Required rate is that. Intrinsic value. Okay, so when you see all of that, draw a timeline. Okay, so T0, T1, T2, T3, T4, T5, T6, T7, T8, and so on and so on and so on. Okay, the question said they just paid a dividend, so div 0 is 2.12. Then they said assume over the next 3 years dividends will grow as follows. Okay, so this dividend will grow at 1, so 1.25, so add an extra 25%. 12% in year 2, so this times 1.12, 12%, 25, then 12%, and then 10%. This times 1.10, 10%. Then they say expected growth level constant at 7%. So then it's going to be this times 1.07, and that dividend is going to grow forever and ever. Okay, so that's Gordon growth. So that's PV equals div 1 minus divided by brackets R minus G, close brackets. Okay, so first things first is to get that answer. Okay, so 3.493336 divide by open brackets R, what was R in the question? Required rate of 0.12, 12%, less constant growth of 0.07, close brackets equals. Type that into your equation, your calculator, and you get 69.86. Right, then I've obviously got future dividends, so those dividends, and I've got this present value which I just worked out, which is 69.86 dot dot dot, that I need to discount back in time using my cash flow on my calculator. Okay, so that's the shortcuts. Okay, remember, use the easy way of doing things. Right, the quickest, simplest, fastest way to get to the right answer. Okay, cash flow here would be that. Cash flow here would be that. Cash flow there would be this plus that. Okay, insert I is 12%. Solve for net present value. Okay, so let's do that on the calculator. Go to my cash mode. I is how much? 12%. Start with the cash flow 0, then 2.65, then 2.968, and then 73.13152. Okay, solve for NPV. NPV comes out as 56.78 571429. Brilliant. Okay, I must compliment UNISA in terms of the INV modules. They are very good in terms of questions and answers. They've almost never had any problems with their past papers. There have been one or two slight queries, but nothing major compared to other modules like the finance modules, which are problematic most of the time. So the INV modules are very well managed. So I do always give compliments to UNISA for managing this particular module very well. 17 is 56.79, which is option 1. Okay, so more often than not, you're going to get one of the answers that are there. Okay, let's look at the next one. 18. What is the beginning of year payment that would be used to amortize a loan of that over an 8-year period at that interest rate? Okay, that's amortization. That's a normal loan calculation. Okay, so obviously I'm amortizing a loan, so PV is 128,500. That's the loan that I need to pay off. What is the beginning of the year payment? So make sure you definitely use begin mode. Um, 8 years, so N is 8. I is 6.5%. Solve for PMT. Alright, so grab a financial calculator. Begin mode. N, 8 years. I, 6.5%. Present value, 128,500. Solve for your PMT. I get 19,816.42504, which is option 2. Question 19. Assume the ordinary shares of J trades at 68 Rand and the firm's book value is 4 Rand 50. The firm has an earnings yield of 13% and a dividends yield of 13%. Calculate the price to book value ratio for the firm. Okay, so this is a ratio. You're going to have to need your price to book formula. which is price to book, which is price over book value, and then I'm going to need book value. Where's my book value equation? Okay, there. Alright, so book value per share is that. Okay, and what did they want? They want price over book value. Okay, so I've got book value. That's easy. Then just obviously price is price. Okay, so P over B, price over book value equals the current price is 68 Rand. Divide by the book value, which is your total assets. Oh, they gave you the book value, so that's even easier. Okay, 4.5. Alright, so that was a very easy question actually. So 68 divided by 4.5, 15.11, option 2. Okay, that was very straightforward. Okay, you need one more question to pass. Remember, 20 questions gives you a pass. As long as you get the easy questions right, you should be able to pass this exam paper. Okay, R currently retains 40% of its earnings. So again, retention is 40%, which are 6 Rand per share this year. So that's the retention. It earns an ROE of that, assuming a required return of 16. How much would you pay for the share on the basis of the earnings multiplier model? Alright, so obviously earnings multiplier model is basically a way to calculate the value. Okay, how much would you pay for the share? Okay, so basically if we look at the price earnings multiplier, so obviously P over E times E would give us the price, right? So that's basically what you're using as the premise for your calculation. Obvioususly you need to work out what the price is. So I first need to work out well, let's see, what do I have here? I've got it earns an ROE of that, assuming a required return of that. So I've got the required return, I've got ROE, I can work out the growth rate. G equals retention times ROE. Okay, so R currently retains 40%, so 40% is your retention, times ROE is 30%. So 40 times 30 is 12%. So 12% is your growth. They say currently retains 30% of earnings, which are 40% of its earnings, which are so the earnings which are 6 Rand per year. So obviously payout is the 60% times the 6 Rand, which would equal your dividend. That's the dividend that you're paying out. Okay, so in order to work out the price, PV equals div1. This is currently retains. So currently means now. So you're going to have to compound this for one period in terms of growth. 1 plus growth of 12% divided by R minus G. The required rate of return was 16% minus the growth, which was 12%. Close brackets equals 180 cents, option 4. Okay, and that's 20 questions correct so far. Right, so you can see that if you practice and you do pass papers, you should be able to do well. You should at least pass and then focus now on your distinction. Okay, notice I haven't done any of the difficult bond calculations yet. Convexity, duration, all of that. I haven't looked at any futures yet or even options. So you do need to focus on trying to pass and then get your distinction later. Good exam technique always. Okay. Right, 21. Which statement correctly describes the relationship between the yield to maturity, coupon rate, and price of a bond? Okay, if the coupon rate equals the yield, then that will be trading at par. So that's wrong. If the coupon rate is less than the yield, okay, if the coupon rate is less than the yield, then the bond will be at a discount. So the price will be less than its face value, not that one. Okay, coupon rate greater than yield. So if the coupon rate is greater than yield, the bond will be at a premium. Okay, because the bond is offering more interest. Coupon rate greater than yield, so it'll be face value, no, it'll be price greater than face value, so that one. Okay, coupon rate greater than yield, bond is trading at a premium, price more than face value, option 4. Next question, 22. Consider a bond with a 9% coupon payable semi-annually. A 1,000 face value and the selling price of that. What is the current yield of the bond? Okay, so this is a very specific formula. You just need to remember what current yield is. Current yield is the annual coupon divided by the bond price. Right, so the annual coupon here is 9% of face value. Divide by the current price. %11.44%, option 3. Question 23. What does a high accounts receivables turnover ratio signify? Okay, so we're looking at a ratio here, accounts receivable turnover. Company has a tight credit policy. Yes, because if it's a high accounts receivable turnover, that means sales over accounts receivable is high, meaning you're selling, and you've got low accounts receivable, meaning you're collecting your outstanding debtors. Company is insufficient utilized fixed assets? No. Has a debt collection problem? No. Company has difficulty in paying interest and principal? No. Option 1 definitely. Question 24. Assume you purchase 105 shares on margin for 72 per share. Also assume the initial margin is 60 and shares pay no dividend. What would your rates of return be if you sell the shares 1 year later for 85 per share? Ignore interest on margin and assume you do not remove any money from the account prior to selling the shares. Okay, so they want your percentage. So we need to get the present value, future value, and all of that. Okay, so assume you buy 105 shares on a margin for 72 Rand a share. Okay, so present value I buy -72. Also assume the initial margin is 60% and the shares pay no dividend. Okay, so they pay no dividend. What would your rate of return be if you sell the shares 1 year later for 85 Rand a share? So FE equals 85, and it's looking at 1 year later, right? What did they say? Yeah, 1 year later. Solve for I. Okay, on your financial calculator, 1 year, -72, future value of 85, solve for I comes out to, that's 18.05%. That's not one of the options. So let's read the question again. Assume you purchase 105 shares on margin for 72 Rand per share. Okay, that's the that's the margin. Okay, so if it's the margin, also assume the initial margin is 60% and the shares pay no dividend. Okay, so that means that 60% is actually what we've got there. So we need to work it out in terms of present value, because what would your rate of return be if you sell the shares 1 year later for 85 Rand per share? Let's see. 06 times 100 divided by 0.6. 31.01. Yeah, that works out. Okay, so on your calculator, this is the amount, okay, before the 60% margin. Alright, so that means if I take the 18.1, well, 18.06 and I multiply that by 100 over 60, I get 18.06, not 18.6, sorry, that's a mistake, typo. There we go, that's better, which is 30.1, okay, which is 30%, option 3. 25. An investor has a 12% semi-annual paying bond with the par value of that. The bond has a market price of that, 25 to maturity. What is the bond equivalent yield? Okay, so we're looking for the I, the yield. Okay, so N, it's a semi-annual bond. How many years? 25 years. So 25 times 2. I've got the market price of negative 1100. And I've got the future value of 1,000, and I have a payment of 12%, which is semi-annual. So 12% of 1,000 divided by 2 equals 60. Solve for I, and then you times the I by 2. Okay, to get the bond equivalent yield. Okay, so N is 25 times 2. I is what I'm solving for. PV, which is the bond price, market price, 1100. Payment, 60. And 1,000 future value. Solve for I. I comes out to 5.416603455. Right, which I'm going to multiply by 2 because it's semi-annual. Gives you 10.833%, option 4. Okay, question 26. Calculate the equivalent 12-month spot of bond B using the bootstrapping method. All bonds have a face value of 100 and semi-annual coupon payments. Okay, so with bootstrapping is stripping. So you're literally stripping the bond into its zero coupon bonds, and you're discounting all of that back in time to get a price for it. So here they want the calculate the equivalent 12-month spot of bond B. Okay, because they've given you prices here. Okay, so you're working backwards. Alright, so in order to calculate this, we're going to need the price. So they want to know, calculate the equivalent 12-month spot rate of bond B, okay, using the bootstrapping method. Okay, so we need to do bond B's price, which is 102.72. Bond B's price is going to equal, okay, bond B is paying how much? An annual coupon, okay, and this is calculate the equivalent 12-month spot rate of the bond. And then they said here, see, all bonds have a face value and semi-annual coupon. That's important. So it's half, the coupon would be half of that. So we'd have to discount the future bond prices back in time. Okay, so let's first work out bond B's coupon. Bond B's coupon would be its face value, which is 100, times its coupon rate of 13% divided by 2. Gives you the semi-annual coupon. 6.5 is the coupon. So if I'm discounting future bond prices back in time, so the first coupon would have to be discounted back in time. So it'll be 1 plus the current 6-month spot on bond A. So maturity, see, maturity is 6 months and the yield is 8%. So it'll be plus 0.08 divided by 2, close brackets, to the power -1. Okay, then you'll add the next coupon, which is 6.5. Okay, open brackets, 1 plus the rate for 12 months. The 12 months here is yield to maturity, 10%, but we're looking for the 12-month spot. So the 12-month spot would be this, spot rate divided by 2, close brackets, to the power -2. Okay, then add Then we've still got the final value, which is 100, which is the face value that needs to be discounted back in time, which is 1 plus this would be in terms of the 12-month spot, this is the end value, so that needs to go here actually. Okay, it's 1065. Okay, because it's the future value plus the coupon. That's at year 2. Discount that back. Well, not year 2, period 2. Okay, because it's half yearly. So time 1 and time 2. That's what I mean when I say -2. Okay, so now I need to work all of this out separately. Okay, so let's work out what these values are currently. 6.5 open brackets, 1.04 to the power -1 close brackets equals. Okay, so this 6.5 taken back in time is 6.25. Okay, then plus. Alright, then I've obviously got a bracket here, which is basically what I wrote here. Okay, so take the 6.5 across. So 102.72 minus 6.25 equals 96.47 equals that. Okay, then take the 106 to the left, so divide the 96.47 by 106.5, gives me this 0.9058215,962, okay, equals the brackets. Alright, so now if I times this by, I'm going to have to get rid of the -2. So to get rid of a -2, I'm going to have to times this by, in terms of getting rid of it, I have to times it by -1/2. So this will be to the power -1/2. Okay, it's just doing the arithmetic now. So I'm just taking that figure. Okay, so that amount, okay, to the power, get rid of the exponent, so I'm going to times that by an exponent -1/2 close brackets. That gives me this answer, okay, which gives me 1.050699836 equals, see, now I've gotten rid of that exponent, -2. I'm just doing arithmetic here, mathematics. Right, so that is now gone. Okay, that was the next step. And then obviously take the +1 on this side to that side. So then -1 from that side gives you 0. All of that equals S/2. Right, then times this side by 2, so that times 2. Oh, that didn't work. Let's do it this way then. Times 2. Okay, equals spots. Okay, so the current 12-month spot rate on bond B would be 10.14%, which is option 4. Yeah, there's it there. Right, 27. Which of the following bond experiences a 100 basis point change in the yield to maturity? Okay, so the following bond, 100 basis point change is 1% change in yield. What is the duration of the bond? Okay, so they want the duration here. So that requires a formula. Obviously, you need rate decrease, you need rate now, and then you need rate increase. Well, actually, if the rate decreases, the bond price will increase. That must go that side. If the rate decreases, the bond price will increase. Okay, and then obviously NI, PMT, FV, and then PV is what I'm solving for. Right, so you draw up a little table, you get those values. Okay, so time to maturity, 4 years. This is semi-annual though, so 4 times 2, which is 8. Current yield is 8%, so divide by 2 is 4. Then we've got the payment. The payment is the coupon, which is 1,000 times 6%, divide by 2, which is 30, and the future value is 1,000. Alright, and I'm looking for a 100 basis point change to both sides. So the rate increase and decrease, so that if it's currently 4, it'll be 0.5 here, and then it'll be 4.5 there. Right, and everything else will stay the same. 8, 30, 1,000. Solve for your present values. Right, so then I'm going to do in my calculator, grab the financial calculator, insert N8, I4, PV, I'm solving for it, payment 30,000. Okay, so if I put in a rate of 4%, my present value comes out to 932.67255513. Alright, then if I change the rate to 3.5, my present value comes out to 965.63022223. Okay, that was a rate decrease, rate decrease, rate decrease, rate increase. Oh, I got this wrong around again, sorry. Let me swap that back. Rate increase. Okay, rate increase, rate decrease. Right, so the rate decrease, the bond price is increase. That's correct, yeah. Okay, and then let's work out the other one, 4.5. Solve, I get 901.061709. Okay, so there I've got all of that. Then I need to go to my notes, and I need to get the equation for duration. Convexity, effective duration, that's what I need. Okay, so that's what you would have to learn going into the exam. Make sure you know these equations. That's the effective duration. So, effective duration, duration equals brackets, bond price rate decrease. Bond price rate decrease. So, brackets, bond price rate decrease. Bond price rate decrease. Bond price rate decrease. Rate decrease is that minus bond price rate increase minus that. Close brackets. Divide by open brackets 2 times. 2 times initial observed price, which is that, times the change in rate, which was 1%, so 0.01. Close brackets equals, okay, 3.46. 3.46, that's it, option 1. Question 28. Calculate the convexity effect if the effective convexity is that, so 83,88, and the yield to maturity changes by, this is 1.5%, okay, in terms of percentage. So they want to know, calculate the convexity effect if the effective convexity is that. So effective convexity is that, and the yield. Okay, so where's my equation for convexity? Here's it. Yeah, convexity. Okay, so I'm obviously looking at the convexity effect, which is going to be multiplied by the square of it. Go back to my working. Okay, con equals the convexity times brackets the rate squared. Change in rate squared. Okay, so the convexity effect is what I'm looking for. So my convexity would then be equal to, alright, so the convexity measure 83.88 times brackets 0.0, that's 1.5%, so 15 squared, so I have to multiply that by 0.015, which is squaring it, equals that. That's option 2. Okay, question 9 is theory. Which of the following theories state that the forward rates are of a function of expected future spot rates plus liquidity premium? Okay, obviously that's expectations theory, option 2. Question 30. A dealer quotes the following 1-year spots. Okay, so you've got yield to maturity 1 to 5, and you've got spot rate. Spot rate is the current yield in the market. So the market currently has a spot rate, meaning now. What is the current applicable rate today on a maturity instrument of 1 year, 2 years, 3 years, 4 years, and so on. Okay, they want to know what is the 1-year forward rate 2 years from now. Okay, so that requires that formula for, there we go, forward rates. Okay, so that's what I've got. Alright, so I want to know what the 1-year forward rate is 2 years from now. So 2 years from now would be time 2. And I'm looking for the 1-year forward from there. So that'll be time 3 and time 2. So I'd be looking at 3 and 2. Okay, I'd be looking at the long and the short. Okay, the long rate and short rate. So forward rate equals, open brackets, open another bracket. Okay, so I'm going to have the the long rate, which is 1.134. Okay, close brackets to the power 3. Okay, then divide that by brackets 1.097, which is the 2-year rate. Okay, close brackets to the power 2, then close that big bracket, and then that whole thing to the power bracket 1 over n, so 1 over 1, close brackets, then minus 1, close that bracket, minus 1. Right, and then open up another bracket and times all of that by 100. Alright, so you just need to type that into your calculator. I'm going to do it on my financial calculator. It's much easier. Instead of doing it on Excel, clear the memory. Okay, so open brackets, 1.134 to the power 3, close brackets, divide by, open brackets, 1.097 to the power 2, close bracket, close bracket, close bracket. Okay, to the power 1 over 1, which is 1, minus 1. Okay, times 100 gives me this. So the forward rate on my calculator comes out to 21.17859381%. Is that there? 21.17. Did I put this in correctly? Let's go back and check. 1.13. Was it 1.13? 1.134. Yes, I've got 1.134. That was to the power 3, and then 1.97. Yes, to the power 2. Yeah, that's all right. So here the decimals are slightly out. What is the 1 year forward 2 years from now? You would go with option 21.31. I've got 21.73. It should be exact, but it's not, so that's odd. So I'm going to go with option 2 here, being the closest answer, based on the forward rate equation from the textbook. Okay, question 31. Forward commitments are contracts in which two parties enter into agreement to engage in a transaction at a later stage at a price established at the start. Which of the following combination consists of derivative instruments that are classified as forward commitments? Okay, if it's a forward, swaps is a forward, options isn't a forward, futures is a forward, forward contracts is a forward. So A, C, D. A, C, D, option 3. Option 3. Okay, the next one. What is the theoretical futures price? Okay, so futures price, we're taking something now at spot and we're taking it forward. So F believes he has identified an arbitrage opportunity for a commodity and indicate the following information in the following table. Okay, so the spot price for a commodity is that. The futures price for a commodity expiring in 1 year. The future price for a commodity expiring in 1 year. So that means it's the current thing that I need to take forward, and that's the spot price of the commodity. So what is the theoretical futures price? 1 year interest, that's the 1 year interest rate. Okay, so I need to work out the current theoretical futures price. So futures price meaning what is it theoretically now. Okay, because the futures price is a price that's quoted now in the market that relates to something that's going to expire in 1 year. So I need to discount the spot price for the commodity. That's the futures price for commodity expiring in 1 year. In 1 year, so meaning in 1 year later on. So that means I need to discount. Okay, so I'm going to take, what was it, the spot price, 140, and I'm to take that forward for 1 year because it's the current spot price of the commodity. Futures price for commodity expiring in 1 year. So in 1 year, meaning in the future. So then the 1 year interest rate is 8%, so 1.08 for 1 year, so to the power 1. Okay, because it's the futures price. I want to work out what the futures price would be based on the spots. Okay, so what is that? 140 times 1.08. Okay, 151.20, option 4. Okay, 33 to 34 is using this information. Okay, a share is currently selling for 60. Okay, currently selling for, that's the current market price, and has a call option with a strike price of 45. Okay, so strike price of 45 means I can exercise the call at 45, so meaning I can buy at 45. That's the strike price. It's currently selling for 60. The call premium is valued at 5.65. Okay, what is the break-even amount for the call holder? Alright, so that requires your equations, so let's go to the options. Okay, there's the call option. Okay, so call value is market price minus strike. Call equals market minus strike, 60 minus strike of 45 equals 15. Okay, the call premium is valued at 5 Rand 65. So they want to know what is the break-even amount for the call, meaning I ended up with 0. So that means, but I paid, so then less the premium of 5 Rand 65. Okay, so the call is currently in a profitable situation because 15 minus 565 gives you 935. So the call is actually profitable currently. They want to know what the break-even amount is. So break-even means I end up with 0. Okay, so I want 0 here. What is the break-even amount for the call? So what is the market price for the call? That's the big question. Okay, so if it's 0, I need to make the premium. That means the call must equal question mark minus the strike price of 45 equals the premium of 5.6. Okay, so then solve for the unknown, okay, which is 45 plus 5.65, which gives you 45 plus 5.65, which gives me 50.65. So that's option 3. Okay, that's the break-even value. So if if the market price was 50.65, that would be the break-even amount for the call holder. Okay, 34. What is the maximum profit to the call writer? Maximum profit to the call writer, the writer of the call. The writer of the call is the person writing the call, so it would be the opposite position. So the maximum profit that the call writer would be able to make is the premium. Okay, because that's the writer of the call. So that would be the premium. Premium of 5.65. So that's option 1. Because they're the writer of the call, they're issuing the call. Okay, question 35. Calculate the lower bound price of a 9-month European call option on a non-dividend paying share, and the share is currently trading at that, or the strike price of that, and interest rate. The lower bound is closest to. Okay, this is very specific. They're asking about lower bound and upper bound. Okay, so we need to refer to the textbook here. Lower bound of a European call. Okay, so let's find that in the textbook. Let's see, European calls, call options, page 240. Okay, so if you go to page 240, you'll see the future contracts here, and options start here. There's the strike price, there's the options, there's the graphs. I want the upper and lower bounds. Okay, there's it there on page 250. Okay, so page 250 gives you the upper and lower bounds. What did they want here? The lower bound. Okay, the lower bound for, we're looking for what type of instrument? It's a 9-month European call option. Okay, so if we're looking at a European call, I'm looking for the bounds for a European call. That was an American, the value of a European call. Okay, there we go. And I want the bound. Okay, so the bound here is the lower bound of a call option is S minus X brackets 1 plus R to the power minus T. Minus T, right? Yes, it's minus T. Okay, that's the formula that we need. Okay, so then obviously I'm going to substitute the information in. Okay, so the current spot in the market is currently trading at 68. The exercise price or strike price is 55. The rate that was given in the question was 0.07, and the time given in the question is 9 months, so 9 over 12, close brackets. Okay, so lower bound equals, type that into your calculator. Let's see what we get. Okay, so 68 minus 55 open brackets 1.07 to the power negative 9 over 12 gives me 15 Rand 72 129077. Okay, so that's the lower bound of the European call, option 3. Question 36. Share A is a standard deviation of that, while share B is a standard deviation of that. The covariance of the two shares is this. What is the correlation coefficient of A and B? Right, that's a formula that you need to know in terms of your statistical measures. So I'm going to go get that formula from my notes. There's it. Correlation. That's what I want. Okay, so share A, they want the correlation coefficient. So correlation equals covariance 0.026 divided by open brackets 0.29 times 0.17 close brackets equals, gives me an answer. Let's see what we get. 0.527, option 4. Question 37. Okay, so portfolio is made up of share R and share W. Share R has a standard deviation of that and a weight of that. Share W, on the other hand, is a standard deviation of that and a weight of that. The correlation coefficient of share R and share W is 0.5. What is the standard deviation of the portfolio? Okay, that's correlation coefficient. So that's the formula that we have for two different assets. I need that equation from my notes. Go to my notes. It's on the last page. Where is it? There we go. Okay, portfolio standard deviation. Right, so that's the equation that I'm going to need for the portfolio standard deviation. I'm going to have to insert the information that I've got in the question. Right, so let's start with W1. Okay, so weight 1 is 20%, and standard deviation 1 is 20%. Okay, so they're both 20, that's simple. Okay, then weight 2 was 80%, and standard deviation 2 was 10%. Okay, and then obviously your R here, R was given as 0.50. Right, so that's what I've got. And then you're literally substituting all of that in and working out your answers. So portfolio standard deviation equals, alright, so I need to grab my financial calculator, or normal scientific actually might be better here. So then I would have to square root. Okay, so square root, open brackets. Okay, first term is W1 squared. Okay, so 0. Okay, I think I can actually do this on Excel. Let's see if I can. Let's do it here so you can see what I'm doing. So square root, open brackets, then open brackets. Then I need to multiply this. Okay, so W1 squared. So W1 squared is 0.20, 0 times 0.20. Okay, and then multiply that by SD1 squared, which is 0.20 times 0.20. Okay, close that brackets, plus, then open up a bracket, W2 squared is 0.8 times 0.8, so square it, okay, and then multiply that by 0.1 times 0.1, close that brackets, plus, open brackets, 2 times W1 is 0.2 times W2 is 0.8 times the R, which is 0.5, times the standard deviation 0.2 times the standard deviation 2, which is 0.1, close brackets, gives me that answer there. What is the standard deviation of the portfolio? That can't be right unless I made a mistake here. Brackets, let's add more brackets here. Brackets. Okay, brackets there, and then brackets there, and brackets there. Still gives me that answer. What did I do here? Oh, the 2 must be outside. No, it shouldn't make a difference. BODMAS is still applicable. Okay, let's do it on the financial calculator. Not financial, the calculator, normal calculator. Okay, so square roots. Let's work out these values on their own. Okay, so W1 squared, WSD1 squared, and then W2 squared and SD2 squared. Okay, let's work out what those things are so I can put them into the formula. It might be easier to do it that way. Okay, so W1 squared, W1 portfolio is made up of share R and share W. Share R has a standard deviation of 20% and weight of 20%. Yeah, it's the same thing. So 20%, 0.2 times 0.2. Okay, and then we've got standard deviation is 0.2 times 0.2. Okay, then we've got the weighting. Share W, on the other hand, has a standard deviation of 10. So standard deviation of 10, 0.1 times 0.1 squared. And then weighting of 0.8 times 0.8. Okay, gives me this. Okay, and then we've got the correlation coefficient is 0.5. Yeah, that's right. Okay, and then R is that. Okay, so on my calculator, square root, okay, brackets, W1 squared times SD1 squared plus W2 squared times SD2 squared plus 2 times the weightings. The weightings were 20 and 80 times the correlation coefficient times the standard deviation of 0.2 times 0.1, close bracket equals. Yeah, I still get that answer. Okay, so I do think there is a problem with this question. Then you get the same answer, you still get that answer. Okay, so here I would say there's errata, definitely. Okay, because we're using the equation portfolio standard deviation and we're getting that answer. Okay, obviously if I times this by 100, I'm going to get 10.583%. Right, and that would be the portfolio standard deviation. Right, because look at this, you can see that there's a mistake here, because obviously the standard deviation here of the one asset is 20 and the standard deviation of the other asset is 10%. You can't have a standard deviation for the portfolio that's lower than 10%. Okay, because if I had to invest the full 100% of the portfolio in share, what share is this? W. Okay, that means the portfolio would be 100% invested in portfolio W or share W, and that means the standard deviation of the portfolio would be the standard deviation of the share, which is 10%. So it's impossible for the standard deviation of this portfolio to decrease and to become lower than 10% if you've got standard deviations for both separate shares being both more than 10%. So there's definitely errata with this question. Guaranteed. Okay. 38. This is theory. Which of the following strategies is a fixed income portfolio management strategy? Okay, where are you looking at fixed income valuation? We're looking at bonds and we're looking at yields. So 4. Yield spread analysis would be a strategy for investing in fixed income instruments. Right, question 39. An analyst has collected the following information on different investment portfolios. Assume a risk-free rate of that. What is the Sharpe measure of L? Okay, so I'm looking at L only, and I want Sharpe. So Sharpe is that equation there. Right, so Sharpe equals, open brackets, the average return. Okay, what's the average return here? Average rate of return is 13%. Okay, minus the market risk-free rate, which is 0.9%. Okay, close bracket, divide that by the standard deviation, which they didn't give you, they gave you the variance. So then the square root of the variance, okay, is going to give you the right answer. Okay, so equals square root of 14%. Square root of 14% is that. Okay, so Sharpe is going to be this divided by 0.374166. Alright, so if I take that and I calculate an answer, I get, that's the Sharpe measure, which is 0.1. What's wrong with this now? Did I average return, average return, so 13%, 1.69. My decimals here aren't right for some reason. Let me just see, what did I do wrong? 14%, square root of the variance, 0.14, square root of 0.14 is 0.37. Yeah, that's correct. And then we've got average return minus the average market risk-free. Average market risk-free is that. You had the variance. What is the Sharpe measure? The Sharpe measure is 0.1. That's again strange. You don't have an option for 0.106, but you've got 1.06. Unless they left out a comma somewhere here. Well, beta, there should be a comma there. Risk-free is 9%. Portfolio L's average rate of return is 13. Yeah, so 13 minus 9, that's 9%, divided by the square root of the variance. It's correct. There's nothing wrong with the working. Unless I have to use the percentage. So let's try this. Sharpe equals brackets 13 minus 9, close brackets, divide by, open brackets, square root 14, close brackets, equals. Let's see what we get there. Okay, so equals square root 14, square root brackets 14. Okay, it gives me 1.37. Alright, and then we've got open brackets 13 minus 9, close brackets, times, not times, divide by that answer there, equals. Okay, so that works out. Alright, so be careful then. You can't use decimals, so be careful. You must use percentages in calculating the Sharpe measure. Okay, because you can see if I use decimals like I used decimals there, I got an answer that wasn't accurate in terms of the spacing. Okay, the decimals. Obviously, I need to move the decimal one to the left, which gives you that answer. Okay, so be careful, use percentages. If I use the percentages and not decimals, then you do get the right answer. So the Sharpe measure is option 4. Okay, just be careful, make sure you use percentages instead, just in case. Okay, just to check that. Alright, then the last question. Shares N, M, Z each have the same expected return and standard deviation. The following table shows the correlation between the returns. Okay, so correlation means how they react in relation to each other. Given these correlations, the portfolio from these shares having the lowest risk is, okay, lowest risk. Lowest risk means you would want a portfolio that has diversification. So in terms of diversification, you would want to group shares that are in terms of negative correlation. Okay, so the biggest negative correlation, which would be this one. So you would want share M and share Z. Equally invested in shares N and M and Z. MLU and ZAC. There, option 3. Negative correlation, which is diversification. Option 3. It's a theory question. Diversification. That's what you actually want. And that's the final question. Great, so that completes another past paper.